The second purpose then would be to amend the project costs that were found within that original plan, and that is found on page 17. So in the original plan, we had a development incentive projected at $620,000. Under the amended plan, that would increase to $2,975,000. Also in the original plan, I think it was really more of just an oversight. There was not an allocation for administrative expense, but obviously just as a matter of course, the village has certain costs that it incurs with creation and just the maintenance of the accounting and keeping the district open. So we've quantified that and added that into the plan. So overall, the project cost by this amendment would increase from a projected $620,000 to just over $3 million. I'm going to move to the table on page 19. So the project
Todd, yes. If I could ask real quick, if joint review board members have questions as you roll through, is it okay if they pop in, or do you want to kind of get your presentation done and then spend time answering?
I'm flexible. If folks have questions, feel free to jump in.
Okay, so please do that. I would also note, just so everybody knows, there is one other panelist included here, Steve Summers. Sorry, Steve, I forgot to make mention. Good to see you tonight. Steve is the business manager for the, and that might be the wrong title, I apologize, for the Waunakee School District.
So with respect to the table found on page 19, the brewery expansion, so this would occur on the parcel being brought into the district by amendment to the south. We have a projected valuation for a 100,000 square foot expansion of just over $7 million to be completed in 21. So it would be first fully valued as of January 1st, 22. And then in the original TID9 area, the former Tormac site, we would have a 200,000 square foot warehouse expansion with a projected valuation on completion of about $13.7 million. So all told, $20.6 million in value within the district. On page 20, we have a projection of the tax increments that would be collected associated with that value. So we bring forward that roughly $20 million figure in the left-hand column. We're assuming no change in valuation and no change in tax rates. So we've just held everything constant. And based on that projection, once the facilities are fully valued, we would anticipate collecting about $418,000 per year through the remaining life of the district. This district was created back in 2018, so we have gone through a couple valuation cycles already, the current year and then the upcoming year in which no increments will be collected. So effectively, we've got an 18-year remaining life in which we can collect increment. We would expect that to the extent there is any incremental value created yet this particular year would be de minimis. So we are showing a figure here, but in reality, we don't get that full value until the revenue year 2023. I'm moving now to the cash flow on page 22. And we've now got those tax increments that we just discussed coming in the revenue side. And the expenditures, again, would simply be the pay-as-you-go or the municipal revenue obligation payments totaling to $2,975,000. Because there are two separate facilities involved with the overall project, we've broken that down into a Series A associated with the brewery expansion and an amount of $1,190,000. And for the warehouse, $1,785,000. And then again, we've got those administrative expenses coming in here. Now, based on the forecast, what the cash flow indicates is that the district would actually accumulate enough revenues such that it could actually pay off that municipal revenue obligation by 2030 if desired. So basically it would be, if you look at the full tax increments coming in, it would be roughly an 8-year payback based on the assumed value of facilities and other assumptions that I've detailed. The other item I would like to comment on before I pause and see what questions there may be is, again, getting back to the idea of the charge of the Joint Review Board and the but-for test. So as part of our engagement, one of the taskings we had was to analyze the sources and uses and cash flow pro forma associated with the rental of these facilities to the parent company. And based on using that lens as a real estate development project without tax increment financing assistance, the project actually produces negative returns. With the TIF assistance, it produces marginally positive returns. And the other thing I would highlight here is we talked about the $2,975,000 in payments. So these would be the payments, actual payments made over time, but the value of that upfront to the project in terms of bringing funds, to the table for construction, if we assume an interest rate of 5.25% and a further discount by the lender of 15% to reflect the fact that these streams of payments can vary year to year based on values and tax rates. The current value of that $2,975,000 paid over time is worth $1,850,000 upfront. So in other words, what's actually being asked here is to fill a gap of $1,850,000, but given the interest rate and the discount, we actually need to pay $2,975,000 over time to allow that capital to be raised on the front end. So I'll pause there, and Todd, if you've got other items you want to add.
Real quick, I did want to mention we work closely with Frank Roman from your office, and you had mentioned that he was going to be calling in. I do see another caller on the attendee side with the last four of 9055. Is that Frank?
I'm not certain. Frank, can you raise your hand on the?
I am here.
Okay.
Oh, he's in on panelist side. Okay, great. Thanks. Frank, did you want to add any context to your but-for analysis that you completed? I kind of had a snapshot of the intricacy of the spreadsheet that you guys go through. It is really a pretty substantial scope of work to analyze this. So I did want to ask if there's anything you wanted to add.
I think Todd covered this pretty well, but again, the project costs that we reviewed were for the real estate component of this project. And again, from the real estate side of it, with the assistance that's being asked for, it barely provides a positive return. And obviously, if not having that assistance, it would be a negative return, as Todd mentioned, and likely not to go forward. So the real estate is only a part of the overall operation. So as far as the real estate component of it, it barely covers its own costs, and it marginally contributes to the operations of the company.
Okay, well, thanks, Frank. For the Joint Review Board members, you've got our experts here on the matter of but-for. This is probably a good chance as any to dive into those questions if you want. I guess another thing to clarify, there's no motions required of the Joint Review Board today, right, Todd?
Correct. We're just providing the opportunity to address questions or concerns now, since the next meeting you'll be asked to act.
The reason I like diving into this deeply at this point is if there are questions on behalf of the JRB that require further deep dive on our part or on Eller's part, we want to understand those so we can do that on your behalf prior to the next meeting. So again, having Eller's here, feel free to pick their brains. And then we have the applicant here as well. And I guess if the JRB wanted to have their discussion or explanation on why the assistant is required, that can be asked of them as well. So I'll shut up and leave it to all of you.
Okay, that said, I will open it up for discussion if you have questions. Lori, I'm going to start with you if that's okay. Go ahead, Lori.
Sorry,
Oh,
I'm
that's fine.
having problems with mute or unmute. I don't have any questions at this time.
Okay,
I'm done.
Jim Elvercrow.
Okay, there I am. I guess if Todd could explain a little bit more how the real estate investment is calculated, how you can tie it away from overall operations and come up with just the real estate portion.
I'm gonna, again, as Frank as our expert, since he's on the line, I'll ask him to field that.
Thank you for that opportunity, Todd. The different real estate components are owned under different entities. These are not totally third-party arrangements, but one LLC will rent from the other. So these, they're basically set at market rates and what would be equivalent to what the company would probably have to incur, going out in the market in general. So we looked at just the real estate components of these projects, do the rents and the operations and the costs, et cetera, seem to support the ask that they've requested. Again, this does not address the overall operations of the company. This is only the real estate component of what will support the operations of the company.
And I might just add, it's also important to understand that is what the incentive is going towards, is it's these facilities that that Frank just mentioned. And the other aspect too is, there's a sort of an understood convention or an approach on how you can look at a real estate deal. So, that's easy enough to do when you start talking about trying to evaluate an operating entity. And again, the TIF ask is not to support that part of the investment. That's a whole different case. So our scope is limited to what the TIF is being asked to assist with.
So the revenue for the investment or the facilities, that's based on, you said, market rates or something, when you anticipate the revenue that would be coming in?
Yes, we discussed, the rents and the capitalization rate, the valuation rates, et cetera, with the village's assessor and compare that to some other components as well. So again, realizing that these are not, third-party arrangements, but they do seem to fall in the market parameters of what we'd expect to see there.
Okay, thank you.
Certainly.
Okay, thanks, Jim. David Betcher.
Okay, just to be clear, I guess in my mind, this seems to be an entirely different project than TID 9 was originally created for. It was to develop a piece of land, but the project has changed not only in scope, but actually in purpose and to the company it was intended for. As such, putting it as a comparison in some of the links in the document to the previous project kind of seems problematic, especially when you look at the concept of the possible public works that could be included in this. I mean, based on the sheets we have here, there is no intended public works, correct?
There's nothing with a value. I mean, Todd Schmidt, do you want to address the inclusion of the couple other items?
Yeah, there were two items. I think it was one related to stormwater management and another related to road infrastructure.
Right.
That language was included, not with the expectation that we have immediate projects that might be undertaken, but with the potential that the overall impact of this mixed with other developments within the park might lead to the need to take action on some of our infrastructure. And if that does happen, it would be proportionately shared to the properties benefiting from the infrastructure. Let's say, for example, we got to do recon on half a mile of the road coming in on Unique Drive. And Octopi makes up 20% of the value or some appropriate way to identify its share of impact on that portion of roadway. Under this language proposed in the plan, we could make use of the increment here to support that proportion of the improvement work. Todd, did I explain that correctly?
Correct.
Okay, I find that extremely problematic. because the purpose of this TID was about bringing a new business that would not come without a TIF. That was the original purpose and the original language and the original capital improvements. Now we're looking at a project of a business that already exists within the community, has already bought the land, and we'll get to this question later, but to my understanding already has contracts that basically has a need to build this, whether we approve it or not. It's just a question on their profitability as to building this, not an actual need to get the project to happen. But when you start looking at the capital improvement part and tying it to language from the previous write-up of the TID, we have no guess as to the amount of money you're about to commit to this, because you're lying it on things that may have absolutely nothing to do with Octopi and this TID, other than the fact that it's within half a mile of where you've decided to put up street lights or expand a road for a different business. And we're tying all of this into that, and it's going to start drawing money from it. To me, that's not what the purpose of the TID is. The purpose of the TID is about Octopi building a warehouse and expanding its business. It should not be tied. It should not have capital costs based on some other business building a road within half a mile of Octopi. So for that reason, I have a huge problem with this TID to start with, because you've expanded it in an open way that has nothing to do with the original purpose or the but-for test of this TID.
Let me say that your comments are appreciated, and you're not necessarily. I'm not going to disagree with you. I think that's appropriate. What I would say is that in all the dealings I've had with Ellers, they generally write language with providing a community with flexibility in how a TIF can be used. I would admit that from the original draft of the district, I even drew back some of that flexibility in crafting the draft language with Ellers. And I don't see any, frankly, I don't see harm. It really wouldn't concern me should the Joint Review Board, Plan Commission, and Village Board see fit to remove language regarding public improvements. Because as I said, we don't have any planned at the moment, and I can appreciate how that delivers some uncertainty to you in making decisions. So I guess, Todd, did you want to, I don't suppose that would concern you either, would it?
If it's not a concern for the village, no.
Okay, then now we're back to the, now I'm back to the main one, which is the but-for test. To me, this but-for test right now looks like just a profitability question. Is there concern that this project will not go forward without this TIF?
Todd, may we weigh in on that?
I think it would be an appropriate question to the development.
Okay. I'll just frame it and then hand it over to Isaac. I'm Kate Crowley. I'm with Baker Tilly. We're a financial advisor to Octopi, and we've been working with Isaac and his team to help put together the financing for these investments. And I can assure you as the Joint Review Board that without this incentive from the TIF, that these projects would not be financeable. This is critically important to the lenders that we've been talking to. And truly without it, there would not be a project here. I think Isaac can elaborate on that, but I just wanted to provide that from our perspective as an advisor.
Yeah, thanks, Kate. Yeah, I think it's erroneous to say that it's for profitability. I think it's more for, if we don't have it, it doesn't happen. The banks that we're talking to, they all are calculating the TIF as part of the project. When we started with a $5 million project with 6 people employed. We've grown to close to 100 people by the end of the year in just very short 5 years. We couldn't have done anything without asking for the help that we've asking from TIF and WDC and WBD and everybody involved. So we're really thankful for that. I'm not a huge corporation. The banks, when they see that we're going to do a $70 million expansion, they want to make sure that we have TIF, we have help from WDC, we have the financing, we have our balance sheet, we have, we're looking for equity investors, et cetera, because right now we couldn't self-finance the deal. So it's all these things working together that's going to be able to make it happen. And the one is like, if we don't do it, it's no loss. It's pay as you go. If we don't build the right size, we don't get the money. If we don't employ the people that we said we're going to employ, we don't get the full funds for the WDC, et cetera. So it's more up to us to say, like, this is what we're going to plan to do, and we won't get any of that help if we don't deliver on it. If nothing happens and we don't build, like what happened to the other company, there's no harm, no foul. Nothing will be put away from the village or the district.
I understand that. I hope you understand it from the school district perspective. We put a policy together about how we look at TIFs, and it has to do with the but-for test, because what we're looking at here is taking $4 million worth of property or revenue and stuff off of the school district in a way that then shifts that $4 million liability to the other taxpayers under the school district. And it strikes me as strange when I look at the cash flow projection and we see that this is about helping you get a loan, which I have no problem with. I love your company. I buy your beer. And I think that the food you're putting out on Saturday, the beef, I'm buying it all the time. So quit doing it because it's not good for me. But when I see our expenditures are looking at $3 million basically in direct payments for the warehouses, and we're going to in effect have to pull in revenues of $7 million to do that. And this is about helping you get a loan. I guess to me, it seems like we're paying a lot for an effect of changing a profitability margin of a -1% to a +1% over 10 years. It strikes me strange that this is a financing option. I understand you've already bought the property and you've been looking at doing this. This just doesn't seem the right thing for most of the people under our school district to shift property and to shift taxes onto homeowners for the sake of paying this just to increase the profitability margin. And I gotta, it seems like we're paying out $3 million, having to take in $7 million, and the school district is having to shift $4 million tax burden onto somebody else. And under the but-for test, the company exists already. It's not like there's not even a job creation element added behind it anymore, which I've had problems with earlier ones. If Dean Clinic already exists here, I'm never going to count their jobs as job creation because we're not bringing anybody new to the community. And that's what this TID was originally created for. And this doesn't create that.
It does. We have 25 open positions right now. Once the warehouse is done, we're going to have another 20 open positions. Once expansion is done, we're going to have another 20. So by now, until the projects are done, we want to create another 65 full-time jobs. The other good thing that we're doing is we're paying above market rates. We're seeing right now people moving actually to Wanakee because of Octopi. We have between our business counted 10 people that are living in Wanakee, and most of them have bought houses here. So they're contributing to the taxes to go to the schools. So honestly, it's more like, it's not the profitability. It's more like, if we don't have it, we can't make it. If we can make it, we can create the jobs. And like I said, we've been super thankful for all the help. And I don't think we've seen it as we're trying to take taxes. If we don't build it, it's just going to be vacant land that's sitting there. But we're trying to create some value, of course, to the business, but also to the village by bringing more people in here, to visit us, to spend money here, to live here, kids going to school, et cetera, et cetera. We're putting $70 million of direct investment, but we're probably going to create about $200 million of indirect investment in Wisconsin by buying raw materials from Wisconsin, packaging materials from Wisconsin, transportation, et cetera, et cetera, et cetera. So it's a big project for us, and we think it's going to have a pretty meaningful economic impact in Wanakee and the region by just doing this. If we don't do it, none of that economic impact ever happens.
Yeah, I think it's worth noting. Everyone here's familiar with TIF and sits on many of these joint review board meetings, but these, to just underscore something Isaac just said, is the taxes that are projected in this project plan aren't from the existing operations. So this is all new taxes that would only be there, if we can put together a financially feasible package for lenders, so that Occupy can continue to invest in Wanakee. So while it's a existing business in Wanakee, it's new operations, and that is the intent here, is to facilitate the growth of new operations.
David, any more questions at this time?
No, like I said, our normal look at policy items like this is purely about the but-for test.
So one of the questions, if you don't, I'm just gonna ask you a couple of questions. So I just wanna make sure I'm clear too, based on your statements, Dave. You said that the original TIF that was here, or TID with Tormach, was a new business coming to the community. It's in fact, Tormach was just down the street and they were gonna expand onto this property. So it's very similar in that respect, that you have one business that's already here. So it wasn't a new business that was coming to town. So I just wanna make sure we're on the same page with that.
Well, okay, yeah. That was weird. I understand that, and I also had the problem with the but-for test there. And
Okay,
again,
that's fine. I just want to make sure that, because the way you made it sound, it was only going to be for a business coming into town to attract, which in the event, this is this very similar situation is all I'm saying.
And it's also similar to the downtown one where the developer had already bought the land and already had the hole dug, and suddenly we needed to help him, or the project wasn't going to happen. That's where the question comes in.
Okay, so, fair enough. I'm trying to not compare the other TIFs to this one. I want it to stand on its own merits to see if this is going to meet the but-for test, and I want to make sure of that too. One of your other concerns, you're bringing up the $400 million that the school district is losing revenue from the $400 million.
The $4 million. No, it's about the fact that you're right, the school district doesn't lose revenue. But what we do is we take $4 million off of one property and have to apply it to all the other properties. So in doing that, we're basically shifting the taxes from one person to another. And that's where we have a problem, because then what happens? We have people in Vienna or Westport saying, you increased my taxes. It's like, well, no, we didn't increase the tax levy. What we did was shift some of the tax burden from one person to another. Okay. That's what we're talking about.
Okay, so then Isaac, how many employees, just for my curiosity, moved into Wanakee this year from your business that you're aware of?
That I'm aware of, and we did a final count today, not this year, in the past 3 years, 10 people that have actually bought houses in Wanakee.
So that's a component that I think is important as we consider the but-for test. You know, the fact that we're bringing this much revenue overall in the future, if it doesn't happen, this revenue never shows up. It never materializes potentially, unless Isaac is able to somehow bridge a gap that they're stating that is not there. And that's based on what Kate is telling me as their advisor from Baker Tilly, and our advisors from Ellers are indicating that this would not happen. I wish that it was more profitable, that we weren't looking at a negative 1.1% basically, and we're going to plus 1%. That would be great. But I also look at the economic impact overall to our whole community from this. And that includes why I asked the question for Isaac there, how many employees have moved into Wanakee and the type of paying positions that are there. That's important to this overall, because those are tax-paying citizens that are moving in with those homes.
And it's more the homes. It's the lunches. You know, we go to the restaurants that are in Wanakee. We fix our cars here downtown. We go to the grocery store, the Piggly Wiggly that open up. So it's 100 people that are buying stuff from here, and you know, there's they stay within here because they're not driving to Madison to get the daily stuff here and there. So that's what I'm saying. Like whatever we spend here and the people we bring here, like those people spend money in Wanakee.
And one of the things, if I see that Steve is on here, and thanks for pointing it out, Todd, so I knew Steve was on here. Steve, you said you have a program that you can input these in. I should make sure Steve is there. Steve, are you there?
I am, yes.
Okay, you have that, you said you needed to kind of wait until October before you could put numbers in. You needed certain numbers to be able to look at what impact it would have. Have you run this already within that?
Did I run this? No.
Is that something that you could have ready for our next meeting with the numbers provided? And what that
Yes.
true impact will be on the school and the budget?
Yeah. Yes, I can do that.
Perfect.
Maybe one of the issues you brought up, Chris, is we call these pay as you go, in that the project has to happen before there's any payment. But we're sitting there basing it on the idea of job creation and economic benefit to the community. It's very possible, you could build these warehouses and add a couple of jobs, but maybe not 30 or 50, as some of the numbers it seemed were close to. What if we did the pay as you go based on job creation and residents within Wanakee increase?
Well, I think that we would have to go back probably with Isaac with that comment. And I don't want Isaac to say, well, we should probably go back and look at when we originally gave them TIF when they were going to have 4 employees and now they have 100. He would probably be saying we should have given him more TIF at that time for the job creation that took place. I think that might be walking down a difficult road.
And
Well,
honestly, I would love to do that, but I can't tell people where to live. The fact that they decide to move them, it's on every person's own decision.
Well, that's why my first statement was just pure job creation. But but to sit there and say we're going to pay out $3 million and taking property tax money for people of $3 million and handing it to someone else, and then say your benefit is that they had an increased profit margin and Wanakee got maybe 10 jobs or 20 jobs out of it. I mean, I think Wanakee as a village would be better off hiring 10 people for $300,000 a year and having them work for the village. I mean, that's basically the effect. That's a pretty steep cost.
Well, I don't think that, I know that employees are probably one of our biggest expenses in general. And the more you add, the more, that's a different road to go down and talk about. But I'm not just looking at this from the job creation aspect of it. I'm also looking at it from, yes, we're putting an incentive there. And if the but-for test is really truly it. If this project doesn't happen, we aren't getting a significant increase in tax base that we're going to be getting. And the school district will get eventually. That
20 years from now.
What's that?
And during that time, I've got to raise the taxes on other people.
When do you project closure, Todd?
Yeah, so just as a point of clarification, 2030 is when the district would be projected to close. So it would not stay open for the entire 20-year period.
So that question, I kind of had that question for you, Dave. When you say you have to raise taxes for others because of this, if it doesn't get done, what are you going to have to raise those taxes still? Because there's not going to be a tax. There's not going to be any other taxes that come from this.
No, okay. So
if it doesn't happen, I think that's what we're answering, right? We're going.
That's what we're back to is the but-for test.
Correct.
You're right back to where we started. Which so far, all I've seen is a 2% profit margin difference does it happen or not? And this is definitely very different from most TIDs in that you see a business being created, you see something significant happening. Here we're seeing an existing business basically wanting to expand. And we're saying that expansion will not happen without this type of a financial outlay. And I guess I'm not sold yet because I'm not seeing anywhere in your document other than saying there might be job creation, there might be something, and it's a -1% or a +1%. And I don't think you use TIF money to increase profit margins. You use TIF money for a proven case that you are creating a project that can't happen without it. I get there's the concept of loans and stuff like that, but this seems like a strange way to guarantee loans. I mean, loan guarantees are based on other things than you're guaranteed to get money from property taxes. Now, I'm going to talk with Steve about this afterwards, obviously, and talk with some other people, because like I said, this isn't the typical TID. I mean, we've really redeveloped it from what it was originally created for. And we're definitely arguing the but-for test on very different grounds than usual. And all I'm seeing is the document you gave us, which just says, somebody says, yep. And it's like, well, I'm sure there's more behind it. I'm just not sure why, you know, TIDs were created for brownfields and things like that, and projects that can't happen without that money. Is a loan agreement now the standard for a TID? Maybe. But, you know, I've got a couple weeks to look at it, and I will. These were just my questions to try to figure out what the basis is for why we're here.
Yeah, and I appreciate your questions. Don't think I'm trying to fight with you. I'm trying to evaluate too from all angles and make sure that we are meeting the but-for test. I agree with you that that's extremely important. And that's why we have consultants that look at this on a regular basis. We have a client that is coming forward, which is amazing. You said it yourself. You use them. You like to go there and eat and drink. That's great. That's what Isaac loves to hear, is that people are coming there. They want to expand in our community, and they're telling us we want to stay here, which is great that they want to stay here and not leave to go to another option to get this accomplished. Not that they're threatening that, don't take it that way, but they want to be here, which is great in our community. If we have that type of organization, those type of companies, which in general Waunakie's had, that's a great thing for us to continue with that. Hearing Kate, you know, Kate and Todd, I think it's important that we hear if there's any other angles or things that can help all of us with that but-for test to make sure that it's met.
I do want to ask the question of Todd and Frank. Dave made mention that, and rephrase it, Dave, if I say it wrong, but this is an atypical, unusual, sort of out of the norm approach to TIF usage. Can Todd and Frank, I mean, I know you guys have analyzed hundreds and your firm thousands of different districts. I know this is anecdotal, I'm putting you on the spot, but what do you see as atypical about this project? Is this unusual, and if so, how so?
Well, I would say the only thing that's unusual is, you know, we're dealing with there's essentially an operating entity here, the production business. And as we mentioned, we're really looking at the part we're able to quantify in terms of a real estate investment. But we don't always have that. If we're dealing with something like a multifamily project, we're strictly looking at cash flows coming off that. So, I mean, it's different in that regard, but in terms of the methodology we're applying on the part we're able to analyze, it's not. And Frank, if you've got other thoughts to add, certainly do.
Well, quick follow-up, Todd. So you said that the aspect that you're dealing with the I'm blanking on the words you use, but the real estate deal. Mm-hmm. Does that give you reason to pause? Do you have a concern that we ought to understand in relation to that, as opposed to another version of a deal here?
No, it doesn't give us pause, but again, the limitation is we can only look at that part that we're able to apply the metrics to and quantify. But again, though, I would go back to the point that the assistance that is being requested is tied to that part of the project we've evaluated.
But I have a quick comment because I've been thinking about it, because like I said, you guys helped us with TIF when we started out. Am I correct to saying, like, we're not raising anybody's taxes because we pay the taxes and then we just get the refund back? So there's no expense from, like, we're not raising the taxes for the school district, because again, like, we get the bill, we pay the taxes, and then we just get the refund from the TIF.
So you're looking at it, and Steve's going to have to correct me because he's better at this than I am. You're looking at it at the fact that the increased value of your property would allow you to basically you're thinking your property taxes are frozen. And instead of that money going to the village or the school district or wherever, you're going to be able to just keep that money to help you do your expansion, right?
So here's the thing, like if we don't build it, so there's nothing created. So the school, the village, there's no extra revenue. If we build it, we pay the taxes, we get them back, zero, but we create taxes by people spending money here, living here, etc. So that's a net positive effect on the tax base. After we get the TIF, then the real estate portion kicks in. So and again, I'm not an expert in TIF, but I don't see any way that anybody's getting less taxes. It's more like the real estate taxes, yes, we're getting them back until we're paid with the TIF, but we're creating extra taxes from day one by people spending money in the village, living here, spending here, moving here, etc. So again, if we don't build, there's zero gain. If we build, there is gain. And again, I'm not an expert, but that's what we've seen like since we started.
Okay, Jim Mavacro, go ahead. You're still on mute though. Okay.
Yeah, okay, there we go. I think Todd's question to the other Todd Taves is, I think is a key question here again about the real estate portion of it. And so you've gone to a bank or a financial institution and they don't like the cost share there or the break-even point. And that's the same information that Todd and Ehlers has been using. As bank and that Ehlers are using the same financial models. And I'm just wondering, I think you mentioned, Todd, that it's kind of unique to be having a development like this and have two different entities, the real estate and the operations. Is that correct? Is this rather unusual?
It's not the typical deal we look at. I mean, usually when we apply this sort of a frame of reference, it would be a, something like a multifamily project that's generating an investment income. I mean, here we're combining a manufacturing, production type of a component, with a real estate deal.
Mm-hmm. And as far as the real estate, as far as the revenue and everything, it's an independent arm's length transaction as far as the rents that would be charged and to calculate the break even. Maybe that's a question for Kate. I don't know if she's...
Well, Frank, correct me if I'm wrong, but the conclusion you reached looking at this was that even though it's not strictly arm's length, the assumptions made as to the rents and costs fall within norms that we would typically expect to see.
That would be correct, yes.
Yeah, they're market rents.
And at market rents, yes. If I may, just to say that, I understand Dave's comments about the change in the intent of the TID, but I think there's consideration that because Tormac has not moved forward with that, there's really no value being generated by that site. And that's part of what we looked at on this is the but-for test, is that with this project, this expansion being considered, that there is significant value being placed into that property, which otherwise would not be benefiting anyone. So that's some of the things we look at in this too. It's more of a qualitative issue, but again, I think we should be cognizant of that too.
Okay, Adam Gallagher, you've been quiet and I almost forgot about you because there's no face there, but I see your phone up there. So do you have any questions?
I have no questions. I'm good.
And
Well, okay, go ahead, Lori.
I just want to make a comment. Madison College, we sit on many different JRB meetings, and this isn't the first time that we've seen something similar to this, especially for the growth of a development and a business. So I don't see it as a huge change, but I appreciate all the concerns. I guess we look at it more of the overall growth and the long-term growth for the city of Waunakee, the village. So I would have to say that I don't see as much of a, I don't have as much of a concern, but I do appreciate the concern. And we've seen stuff like this happen around the area. So that's all I wanted to say.
And Isaac, I want you to understand, it's not about thinking a business shouldn't expand or that how that expansion works. But if we looked at every single business that wants to expand and they came in and said they want a TIF and they want their property tax increase money back to help them expand, you can guess how long that would be able to last.
Yeah.
And I mean, when you look at it as a private homeowner and they put an expansion on their house, they don't get to walk in and ask for a TIF to help them get a rate of return back quicker. You know, they have to do it on their own. And the concept of the but-for test is, does the business, is the concept going to happen without it? I mean, we can get into the whole philosophical thing of the fact that TIDs have changed over the years to such an expansion thing that now it has become about, if a business wants to expand, they might as well ask for a TIF, you know, because quite often it gets approved depending on the size of the community and how high and how many TIFs they have going. But when you look at it as an individual homeowner, it doesn't look as good a deal. And while I understand the concept of paying sales tax in a community, that sales tax is not the same as property taxes, obviously, and doesn't affect the community directly the same way. And that's the only reason why our board is taking a policy that our whole emphasis is on pretty much on the but-for test, to make sure that if we're going to shift tax value between entities within the school district, that it's for a valid reason and for something that long-term benefits and isn't just money that would have happened anyway. And that's why we have to take a hard look at that each time.
Thank you.
Okay, any other questions for any of our panelists, or we can actually move on and set our next meeting date? Any other questions? Jim, do you have your finger up? Yes?
Yeah, I guess
Okay,
just
go
one
ahead then,
last
Jim.
question. I don't want to beat a dead horse.
I wasn't sure. You were like, so I
Yeah,
wanted to be sure. Okay, go ahead.
yeah, maybe I've talked enough, but are you also approaching the banks with an operations loan, or is it just for the real estate that you're dealing with the banks?
It's for the entire project. So the project includes a real estate portion and also includes it's not operations, it's equipment portion.
Okay. And there's no problems with the equipment portion of your
The
loan
bank are seeing
application?
everything as one. So like the warehouse is a $20 million project. The expansion for the canning line, it's a $40 million project. So they're seeing both together because at the end, the banks will land on the entirety of the project.
Okay.
Yeah.
Okay, thank you.
That
Go ahead, David.
actually led to something, Jim. So the documentation showing your application on loan and the need for this funding, I mean, that's not in our presentation, but the village has that, or Todd has it, or?
We've provided, oh, go ahead, Todd.
I was going to say, go ahead, Todd and Frank, talk about your process for evaluating that. It doesn't come
Frank,
to
I don't think we're looking at we're not looking at the terms of the deal as it's related to the, the manning or the production part, right?
No, that's correct. And we had discussed this with Kate before. I mean, you look at that in a kind of a matter of how many barrels are produced, and Kate might be able to help out with some of those numbers on the operating side, but this expansion would allow for enhanced production of the facility. I think the last budget I saw was about $67 million, of which a lot of that is equipment. And if anybody of you know anything about brewing, which I know only my share, but that equipment is quite expensive. So I think Isaac's point of talking to the banks on an operating loan and for the equipment loan is separate from the but-for of being able to provide this facility and to have the taxes reimbursed to a certain extent to allow this to move forward. So that more pieces than what we normally look at. Usually it's kind of a one piece, as Todd Taves mentioned, it's an apartment building, or if it's a, medical office or whatever it is. But in this case, there's more of an operating component to it. That's kind of a bifurcated look. But as he said, the bank lending to them is looking at the whole package. We're looking at a part.
So really, for our review on the but-for, since we're trying to analyze the ability, it seems like it's down to the ability of the company to get a loan. We're actually not looking at the loan or talking with anyone about whether they could get a loan. Right? Or did I miss that somewhere?
Well, I think the discussion has been that there's the real estate component, which we're looking at for the but-for portion, is a part of the overall company financing, which includes loans for equipment and operations and all that. So as Todd Taves mentioned, we aren't able to opine on that part of the business. So I'm not sure how further to answer that question. I'm sorry.
Yeah, and where the
Go ahead, Kate.
yeah, I was just say, I mean, where the two intersect is the market rates for the lease between the real estate entity and the operating entity. So in order for those rates to be at market, that's where there's a gap in the real estate portion of this, which is the but-for test for the TIF. There is, there are loans and investors on the operating side, but that's all being projected under the assumption of market rate lease with the real estate entity.
Isaac, what is the total investment we're taking right now again? With the expansion?
The final number that we had today is about $68 million for all projects.
And what was your investment to this point before this takes place? Roughly.
We are about, well, we're currently doing an expansion right now. Once that's done, it's going to be around 40 million of direct investment.
Before the 68 million though, what's there right now? What's the investment there that's currently on site?
I would say 40.
Okay, so once this is all done, you're gonna have about over $100 million invested in.
Yep.
And so we can project then that we're gonna have $100 million of additional revenue. Had we not given you the initial TIF to get started in Wanakee, would that be here right now?
Never. It wouldn't have happened.
All right.
That Chris, quick, just clarification. It's not 100 million in tax revenue. It's 100 million
Value.
in private investment in value. Right?
Correct.
No.
Yeah.
That's what I was asking for. Yep.
But that's not taxable value.
Understood.
That's the investment. Okay,
Understood.
got it.
Yeah.
All right.
Understood. So, okay, I appreciate that. I just was trying to get the whole scope of what that investment is and what the risk is to the person doing this. As Isaac did mention, he's not a giant corporation on the starting this, and that the fact that we have the potential to have $100 million investment coming into our community, that doesn't happen that often in most communities. So it's something that I'm deeply considering with this. So, okay, any other comments? Otherwise, we just need to, I think we have to schedule our next date.
Correct. The village board is scheduled to act on this on November 16th, assuming it's advanced by the Plan Commission next week. We do have to publish a Class 1 notice with 5 days advance publication of the meeting. So we'd be looking at, depending on people's schedules of that holiday week of Thanksgiving, we'd probably be looking at that week of the 23rd or that first week of December, starting on November 30th.
I'm going to be out of town the week of November. It doesn't preclude a Zoom meeting, though, I guess.
One of the nice things about Zoom, I guess.
When I do it.
It is a good thing about Zoom. You can be a little absent and still be able to participate. So, anybody have any preferences? First week of December, 30th date?
My preference would be the week of Thanksgiving because the week after I start calculating tax bills.
That doesn't seem like a big deal. I'm kidding, Adam. Okay, so if we're looking at the week of Thanksgiving, Todd, I believe we have both school board and village board are tied up on a Monday. So that Tuesday? No, are we not? David, how about you in the school? Do you have anything on Monday there?
That's
We
the fourth
don't
Monday.
now, but we probably will, considering our pattern over the last 6 months.
Fair.
I prefer a Tuesday just in case.
Okay, so that Tuesday, what is that date, Todd? I don't have it
24th.
in front of
The
me.
24th.
24th. Does the 24th work for everyone?
I
Lori?
believe so.
It depends what time. If it's 4 o'clock or later, I can.
Oh, sure.
I don't have as much flexibility during the day.
So this 5 o'clock time on that Tuesday?
Yeah. Yep.
Everybody good with that?
Yep.
Works.
Yep.
All right, I'm seeing a yes across the board. So let's plan it for Tuesday, November 24th at 5 p.m.
I would add that as the next couple of weeks move forward to the JRB members, if you have further questions or information that you'd like to see from anybody who's been part of the discussion here today, do call on me. I'm happy to be at your service to help answer your questions as best I can and get information from the parties who can provide it.
Perfect. And Steve Summers, thank you for doing that calculation for us. And if you can send that, I guess, who does he send that to, Todd, if we want to get it out to all the members? Does that come to you, Todd Schmidt?
Yeah, I can work to get it out to the full JRB, unless you just rather have Steve prepared. Well, actually, I should ask Chris, are you wanting that information to be available to the Plan Commission, for example? They've got a hearing on this next Monday, and then the village board has action on this the following Monday. Are you wanting that sort of data? And
Well, let me
Steve,
ask
can you
this question
provide?
first? Dave, are you okay with this? Because Steve is technically under your guise, and he is the employee of the school district. So I don't want to be putting undue work on Steve, I guess. in your guys' time.
As long as Steve's okay with it.
Yep, I'm fine.
You're fine, okay. So how long do you think it would take you to produce that, Steve?
Not long.
Okay, so for our next plan commission meeting, which is next week, Monday, could you have it for that?
Yep.
Okay, perfect. Thank you. So if you could just forward that to Todd Schmidt then.
Okay, and then I'll
Sounds
make
good.
sure that's in the hand of the Plan Commission as well as all the JRB members.
Perfect. Sounds great. Okay. Thank you, everybody, for your comments and going through the meeting. Thank you to all in attendance. And we need one motion.
All
I'd
motion.
like to make a motion to buy the barbecue on Saturday from Isaac, so you guarantee I get my order in at 11, because I know they sell out too quickly.
Okay, so you need to adjourn right now then, so you can make sure you get it done. Is that right?
They won't let you start ordering until 11 on Saturday. You have to hop on the web right away, and they sell out quick. I was there right the first instant. I still ended up number 9. Motion to adjourn.
Okay, a motion by Dave Betcher.
Okay.
And we'll have a second from Lori. Caitlin, roll call vote, please.
Village of Wanakee,
Yes.
School District,
Yes.
Madison College,
Yes.
Dane County,
Yes.
Jim Elvacroak.
Yes.
You're adjourned.
Thank you, everyone.
All right, good night,
Thank you.
everyone.
Good night.